All right, we at the time? Okay, so moving forward, today we're going to talk about revealed preference, when we can find consumer demand for environmental goods through observing their behaviors or measuring their behaviors. And we'll work through what's called the travel cost method and talk through some case studies about that. So here over the weekend, it rained a whole lot. This is this side over here is supposed to be the inches of snow, and here we got the months. And these are the least snowy years, and here we are each and up. We're on tie for the least snowy year. So it rained a lot in Berkeley, but it didn't snow enough in the mountains. So we have to hope for a couple more weekends like last weekend so we can catch up. The snow line went up to 8,000 feet, and so too much of it fell as rain. But we can keep track of the drought as the semester goes on, and maybe the red line will keep going up. Another note keeping, I went through my evaluations from last semester, and I just wanted to add a couple of notes about that. Stuff that came out to me from reading evaluations of the other students. So I really want you guys to make sure you're keeping up with the textbook. I'm in chapter 6 of the textbook right now, so if you're reading along with that, this lecture will be a lot more helpful. If you read chapter 6 after this lecture, it will be more interesting. So keep up with the textbook. I'm not going to say every time which chapter to read. If I say revealed preference, I'm hoping that you can find revealed preference and keep up with that. Next lecture will be on stated preference, chapter 7, so keep up with that. Just expectations about the way the class works. So in my lectures, there's a lot of talking about policy issues. There's a lot of stories about different environmental issues that are famous or in the news. And then I will be throwing the math and the graphs and the Econ 1 stuff in sprinkled in. Just to point out, though, the homework and the midterms and the final will mostly be on the graphs and the math and the Econ 1 stuff that I'm testing you on. So just to be clear, like, I'm telling you a lot of stories because I think that they're interesting and illustrative, and I think maybe that's what you'll get out of the class just as much as the Econ 1 stuff. But keep track that the midterm's going to be on solving problems and graphing things and definitions. Another important thing is there's another professor who I took over with while he's on sabbatical. His name's Peter Burke. He's the author of our textbook, who wrote this textbook for this class. He's a professor in ARE over in Giannini. And you can look at his webpage, and it's got old homeworks, old midterms, old finals, old PowerPoints. So in that I'm new to teaching the class, there's like a history of this class being taught that my class is basically modeled on his class. So I would hope that you would all check that out if you were needing resources for what a midterm's going to look like. My midterms aren't exactly like his, but you'll get the general sense. Here, I don't know, does anybody have a QR reader on their phone? You should get one so that I can send you links through the robot here. I will do this in a couple lectures. Put a link up here for a Google form that we're going to look at. So put a QR reader on your phone so you can go to the link. All right, did you guys look at the homework over the weekend? Did it make your weekend a little hazy? There's a bunch of interesting stuff going on about the economics of marijuana right now that 2 states have made marijuana legal as of January 1st. Washington and Colorado. So this is taken from the website of the Berkeley Patients Group. All of these can be delivered to you if you have a $30 card saying that you have back pain or headaches. So, which I didn't really know about, so I started researching this. This is basically we're operating as if it's legal in California as well. There's attributes here too: smell, density, and then there's the prices. So interesting as the economist, there's the prices. So we have prices on quality, and then what's interesting from the podcast question or from the economics question is, would the legal price be different than the black market price, and which is higher or which is lower? Somebody said something to say? Which guys do you think is higher? The black market would be higher because it's less legal to produce it. Yeah, there's that. I mean, what's hard here is like these people are brick and mortar. They have a store, they pay taxes, they have a fleet of delivery guys, they have a website to maintain. The guy in the podcast story, it's like a guy with a backpack walking around New York City. He has extremely low overhead, right? And he's not paying any taxes. So you have this thing of like, the price should come in lower if it's legal because there's less risk. But on the other hand, all that has to do with being a legal business, whole tons of paperwork, paying taxes. In Washington State, they're really trying to figure out what the right tax should be because they have a vision that we're going to legalize marijuana and it's going to create a whole bunch of tax, to pay for social programs in Washington State. And they want to, have the tax revenue come out right so that the price of marijuana is right. And it's a tricky thing to adjust that and anticipate that. And then there's this really interesting question of the role of legal versus illegal. So we have a black market that's already there. Supply and demand is already getting met. And then we're introducing a legal way to buy things. And certainly in the podcast, there's this question of like the police are still needed to push people into the legal marketplaces. If there was no police and it was cheaper to just walk around New York City with a backpack selling things, there would be no reason to be paying taxes. There would be no reason to be establishing storefronts, going by sort of a legitimate reason to do things. Until consumers shift, because when consumers are used to buying things from a guy with a backpack, that's probably well to buy them. When they get used to buying, clicking on a website and having it delivered, they will change. So a bunch of interesting issues to work through here. So here we go. We're going into revealed preference, and just to start out, we'll think about why we want to do revealed preference. So this is what's called applied demand studies, applied welfare analysis. We need to come up with some numbers for something. And to motivate it from 2 or 3 lectures ago, we think about we have a market failure for an environmental good. We have a market failure for the environmental services that are being provided. And 2 examples we could say are there's an externality. Some environmental asset, some park or some river or some stream is being polluted, and we want to measure some dollar value of that externality. Another way to think about it is there's a public good. There's a market failure for a public good. We need to value the benefit that is in terms of recreation demand so we can justify public dollars being spent on a public good. So these are just broad areas of examples of why we would need to come up with dollar values as some sort of guidance for public policy. Now, in the real world, a lot of times this is the bread and butter of environmental economics, and a lot of times this is because we live in a world that works through litigation, either the government or private parties. There's environmental nonprofits that sue on behalf of the environment. They sue on behalf of endangered species. They sue so that the government will enact the Clean Air Act or the Clean Water Act. So they're going to have to come up with numbers for damages for pollution. A polluter has been polluting a body of water. Either the government or a group will sue the government and say, we want you to clean up this river, this body of water. The damages for the pollution to this water are this many millions of dollars. Or a lot of times within government spending, where should we put a park? Where should we do this cleanup? Where should we allocate money for the EPA to do cleanup? What's what resource is the most precious to be cleaned up or protected first? So trying to allocate some scarce dollars between different different activities. And broadly, we'll talk about this at the end. This comes into the area of benefit cost analysis. We have to come up with dollar values for benefits and dollar values for costs to mitigate pollution. So I'm not going to say that I think that everything in the environment comes down to a dollar value, but these are tools that we use in policy and in allocating resources. So the revealed preference approach, as I said before, is talking about revealing a demand curve for something that's not traded in the market through measuring people's choices and actions, where they have traveled to, what they have done, what they have spent money on. That might be a market good that's linked to a non-market good. Travel cost method is what we're going to talk about today. People spend money on gasoline, on their cars. People spend money to park. People spend money on plane tickets to go on vacations, spending money on market goods that are going to give us an indication of their value of non-market goods. Hedonic pricing, people are going to spend money on property that's going to have a whole bunch of values, including some environmental values and the value of the property. There's a big area in hedonics on wages. People will work for different jobs, and their willingness to work for that job will have attributes of the job based in it. We look at a big cross-section. Statistically, we can get back attributes out. Finally, avoiding harm. This would be like buying water, filtering water to avoid contamination from water. This would include wetland improvements. Where areas get flooded, we need to allocate lands for flooding or allocate wetlands to protect us from flooding, because we would have a damage cost from flooding. So the travel cost, the beginning of the travel cost, and there's in the textbook there's an interesting letter of the person thinking up the idea of travel cost some 80 years ago, looking at the national park. The first question is, how far do people travel to get to a national park? And early on this was, let's just go to the national park and look at the different license plates. We can add up the number of miles traveled from the average of the different license plates. Now it's moved on to surveys. How much do people spend to go on a trip? And then now we also talk about time. How much time do people allocate to go on a trip? And how much time do people allocate to recreation? Some people for a local park may go every weekend. Some people may go once a year. So how many times are people visiting? And then what's the value of their time? This is sort of a tricky one. This is a first take approximation of how to value things, is what's the value of people's time, what's their wage rate. So we can say the value of their recreation is the opportunity cost of their wage rate. It's a little tough in the equity issue because if Larry Ellison goes to visit a national park, he will blow the valuation of all of the rest of us visiting simultaneously. But it's a first approximation. We know how much people's time is worth based on what they're working for, so we can back out what their recreation is worth. So there's some hypothetical data, just like I brought up hypothetical data on bus tours or donuts. And so this is from the textbook. And the idea here is at a lower cost, people will visit more. At a higher cost, further away, at a higher cost, people will only visit once in a while. There's different ways to visualize this data. This idea is that these are different individuals. And this is how many times they'll go in a year to this certain beach. So this person's going to the beach every other week, and this person's only going to the beach a couple times a year. This could also be, we'll talk about later, groups of people sorted by neighborhood, how far away they are from the beach, if you want to get to larger numbers. But we're starting out just thinking about talking to 5 different people, how far they live from the beach, and how many times they would go to the beach. So here's a regression line. So we can put all of this data into a spreadsheet, into the computer, and graph it. One thing to think about here is when we're starting out, this is quantity, and this is price, right? This is dollars per trips. Trip. And this is number of trips. Well, it's already labeled. Right? So it's just inverse of a demand curve, but we can, as we've done in the homework, we can switch the axes around. So we start out with our data, and we have quantity of trips as a function of the price of the trip. And we want to get a approximation of this line. We want to make a linear function out of that. So we're going to use a regression analysis, and we're going to say, please, computer, tell me, tell me what the best fit of this line. How do I get that to go away? Sorry. Okay. And in regression analysis, we would call this y variable. We would call this the independent variable is a function of the dependent variable. So the independent variable is what we're trying to study, what we're trying to find an approximation of, and the dependent variable, I just totally misspelled that, is what we have the observations of. So we have, the computer gives us an approximation of this line here, and then for each line we have the actual data is this triangle, and here's the predicted value along this line. So the line represents a series of predicted values, how many trips we predict somebody would go at a different price. If we look down here at the low price, the predicted value is right on the line. If we look up here, the predicted value is a little bit off of the line. So this is mapped down here to what we would call the error series. So this is just differentiating from 0. This is how far the error is off the predicted value. The actual value minus the predicted value would be the error. And the way we do a regression is we minimize these errors. So we have an error series, which would be a series of numbers that are how we differ from our prediction line. And what we do is we ask the computer to minimize the squared error. We square all the error terms. You guys know about regression analysis? Most people? Some? It's really important. It's sort of going on behind a whole lot of things. Here in economics, it's going on, right now I'm going to motivate, it's going on behind the scenes of making a demand curve. But it's a powerful tool in statistics that goes on behind a whole bunch of different things. So it's not really the purview of this class to teach you regression analysis. You should definitely take statistics, and you should take a regression class in statistics. It's super useful. It's one of the more useful things you can get out of this major. It's a really useful thing to come out of college knowing how to do. How to deal with data is big, and regression analysis is a classic. Here's a different one. Just to show you nutrition, public health, epidemiology. This is total cholesterol and body mass index. So are people that are overweight going to have higher cholesterol? This is a question. We need to test it. This is a hypothesis test of testing that. So we have statistical techniques to think about that. So we'll have, again, a slope here, an intercept, how far this line will shift up and down, and a slope term. This is how much, at the rate at which cholesterol goes up as body mass index goes up. We take the computer, again, the computer wants to minimize the square of these errors, the difference from this line, and come up with a line that fits the data best. That's how we're going to test hypotheses. So back to travel cost method. Remember this regression analysis, though. We're going to see it a whole bunch more times. So this is just a sample we'll walk through. There's 6 steps. First, say we have a park or a river. Step 1, let's define zones of distance going out from the park or the river. And then we need to think about how much population we have in each one of those zones as we go out. Step 2, we would go to the asset, we would go to the park, and we would collect information on how many people are visiting from each one of the zones. Hi, you're visiting the river today to come fishing. Where did you come from? How long did it take you to get here today? Then we can calculate the number of visitors per the size of population, so per 1,000 people in that ring. And then we can estimate this regression, estimate this, step 4 was calculate the cost for each area. For each ring, we would have a different cost. And then we would estimate a demand based on this regression, minimizing the sum of squares. And we'll use that results to have a demand curve. And when we have a demand curve, we can go back to welfare analysis, showing up how much this environmental asset is worth. And I will walk through these steps, so you'll see them again. The first thing to think about, here's Hell's Canyon, a map, something we'll talk about. The data for this example isn't from Hell's Canyon, but you can imagine we have a map. So in this picture, we have Washington, Oregon, and Idaho here. And Hell's Canyon is just a famous place where they were going to build a dam, and the environmentalists got organized to show that the value of the wild river would be foregone, would be a lot greater than the value of the electricity they were going to get from the river. But just for example, we could say, so here's our environmental asset, and we could make concentric rings, say this is 100 miles, this is 150 miles, this is 200 miles. And we could ask people where they are and calculate what the cost was to get here. Like say they were coming to go rafting or to go fishing in the scenic part of the Snake River. There's 2 things to think about while we're looking at a map. As I said, I love maps. As we go further, go up, the population goes up. Basically, this isn't like a regularity, but this is something that would happen on this. What would be 2 reasons why that would happen?
Because the area is much bigger inside the trees.
Right. So the catchment area is much bigger. So, yeah, the bigger circle on the farther out is going to have a lot more people in it because it's a bigger catchment area. How about another reason that's just specific? Like you can just read off this map. The second reason is this environmental amenity is out in the middle of nowhere in the wilderness, and the further we get, the more cities we catch. Now we're catching Boise and Pendleton. We're catching big cities. So in a lot of areas, this is like, environmental amenities are remote. The bigger circle we get, then we catch urban areas. Yeah, just in the ring. It would just be the population in each ring. Because you would want to have number of visitors per ring. So you would only want to have people in each ring and then the density of visitors in each ring. But obviously in this ring, there's going to be, this is just a funny map, but there's going to be almost nobody in the first ring. There's going to be millions of people once you start to include Boise. But anyways, you're defining the distance from the resource, from the river or the wilderness. This is a bunch of just sample data, like the donuts or the bus travel that I got off of a site that explains how to do this on the web. And the way they did this data was they just said, let's have the same number of visitors for each ring, but the share of the population would be declining. So in the far away ring, we have a large population, and we only have 50 people per 1,000 visitors. In the smaller ring, we only have 1,000 people that live out there where the wilderness is, and 400 per 1,000. So 40% of people actually visit this area. But we would get, importantly, we would get the total visits here, 1,600. We can come back to that. We have the total number of visitors visiting. And then what we can do is, this is just a basic approximation, but we could say, let's start with the cost to drive somewhere and how much people's time is worth, just as an approximation. And the people in ring 1, they're going this far. We'll multiply that times the cost per mile, average, to get this price. We know how long it takes to get there, and we have some approximation of what their time is. We can get this price. So we could sum up and get an average cost for somebody in ring 1 to visit the resource. Right? This is a cost per trip, approximated or average for everybody in that ring. Because all we have is number of visits per zone, and we are going to use our spreadsheet to come up with these dollars per trip. So average driving costs, we can just do dollars per mile. We can think about how many miles per gallon average car is, how much people are paying on average for gas. This is dollars per hour for average cost. We could use the opportunity cost of the average wage rate to think about what $1 per hour would be. And then we have a regression. So let's think about how we're going to specify our regression. Okay, so what's y here? We have y and x that we've talked about what we're starting with. Y is number of trips. And what's x? Price, cost per trip. So we have a bunch of different dots on that line, which we would call observations, that we can put in and try and get the computer with the least squares to tell us the alpha and the beta, the a and the b. Sorry, I'm switching back and forth between a and b and alpha and beta, but I hope that's clear enough. So what's a or alpha? I mean, we had this in our demand curves as well and on the homework. It's an intercept. It's a shifter. Something that's shifting our curve up and down.